In 1720, fortunes were made in months and destroyed in weeks. In 1929, markets collapsed, and fear erased decades of savings. In 2008, panic spread globally. Each time, the same pattern appeared. Some people reacted emotionally, others acted strategically. The difference was not access to information, it was psychology. Money has always been emotional. In the early 18th century, the South Sea Company promised extraordinary profits in Britain. Investors rushed in, prices soared. Even respected minds like Isaac Newton bought shares. At first, he profited. Then he re-entered at higher prices. When the bubble burst, Newton reportedly lost a fortune. He later said he could calculate the motion of the stars, but not the madness of men. The lesson was not about intelligence. It was about emotion. Fear and greed override logic. The wealthy understand this pattern, not because they are immune to emotion, but because they build systems to contain it. The psychology of money determines whether wealth survives cycles. Most people see money as a reward. The wealthy see it as a responsibility. A reward is spent. A responsibility is protected. This difference shapes behavior. After the stock market crash of 1929, millions sold equities near the bottom. They wanted safety. But families like the Rockefellers increased investments in distressed assets. They understood that markets move in cycles. While fear dominated headlines, capital quietly shifted into strong hands. The wealthy think in probabilities, not predictions. They know downturns will happen. They do not know when, so they prepare in advance. Preparation is psychological before it is financial. During the Great Depression, unemployment in the United States reached nearly 25%. Banks failed. Confidence disappeared. Yet those who held diversified assets and maintained liquidity survived. They avoided over-leverage. They preserved cash. They focused on long-term value. Fast forward to 2008. When Lehman Brothers collapsed, markets froze. Panic selling intensified. But investors like Warren Buffett deployed capital aggressively. He invested billions into companies like Goldman Sachs during peak uncertainty. Why? Because his psychology was prepared. He once said to be fearful when others are greedy, and greedy when others are fearful. That mindset is simple, but emotionally difficult. Preparation means building habits during calm periods, living below income, avoiding lifestyle inflation, maintaining emergency reserves, studying history, so that when volatility arrives, decisions are guided by principle, not panic. Consider the aftermath of World War II. Europe was devastated, infrastructure destroyed, currencies weakened, yet investors who believed in long-term reconstruction saw opportunity. The Marshall Plan injected capital into rebuilding economies. Industries revived, manufacturing expanded. Those who invested in productive assets during that fragile period benefited from decades of growth. Another example appears in the dot-com bubble of the late 1990s. Technology stocks soared without profits, valuations detached from reality. When the bubble burst in 2000, trillions in market value vanished. Speculators disappeared. Disciplined investors remained. Companies with real earnings and sustainable models survived. Some later became dominant global corporations. The lesson was consistent. Excitement builds bubbles. Patience builds wealth. The wealthy understand something subtle about time. Time magnifies behavior. Small emotional mistakes repeated over decades destroy capital. Small, disciplined actions repeated over decades create it. After the 1929 crash, markets eventually recovered. But recovery required years. Those who abandoned investing entirely missed the rebound. Those who stayed patient participated in one of the strongest economic expansions in modern history. Long-term thinking requires emotional resilience. It requires accepting temporary losses without losing conviction. It requires separating identity from portfolio value. Wealthy families often structure trusts and long-term vehicles to preserve assets across generations, not because they expect perfection, but because they expect human emotion. Structures protect against impulse. They also understand asymmetric risk. Losing 50% requires a 100% gain to recover, so they prioritize survival. Avoiding ruin matters more than chasing rapid gains. This is why capital preservation is often emphasized more than aggressive expansion. Over decades, steady returns outperform erratic speculation. Psychology makes this possible. Without emotional control, compounding cannot operate. With discipline, time becomes an ally. History does not reward intelligence alone. It rewards temperament. From the South Sea bubble to the Great Depression, from the dot-com crash to the financial crisis of 2008, the same truth appears. Markets fluctuate. Human emotion repeats. The wealthy think differently because they understand this repetition. They prepare before panic. They act when others freeze. They think in decades while others think in headlines. The psychology of money is not about complexity. It is about control. Control over fear, control over greed, control over time. And over long enough periods, that control becomes wealth.